course, we have the Delta variant. We now have the OPEC shock. But on top of that, we have just had an exceptionally good half of returns that have just passed, right? Is it going to be harder going to get those same returns in the second half?
Well, I think so, Sherry, but I think it also depends on where you're talking about, which particular region. So for the United States, which of course has had an exceptionally strong first half, our U.S. strategist, David Kostin, thinks that the S&P can finish this year roughly about where it is currently at roughly 4,300 on the SPX. In contrast, we've seen Asia, which actually was outperforming the U.S. by 700 basis points in the first month and a half of this year, had a very significant reversal of fortune and actually has slipped 14 percentage points in terms of relative performance. So with Asia only clocking about 4 to 5% returns in the first half, we think there's an opportunity for some catch-up, really driven by the delivery of underlying earnings and valuations that are not especially stretched. So, as you said, we're looking for 8% return in the second half. On a 12-month view, we're looking for about 13% return in price terms, and even up to 15% if you add in the dividend yield. And that's obviously not quite as significant as it was last year, but against probably losing money in bonds and making no money in cash and very little in credit, we think that equities still are the appropriate place to be from an asset class allocation perspective.
So, Tim, I don't think any of us had, prolonged OPEC stalemate on our bingo cards to start off the second half, right? But this is where we're at. Who are the beneficiaries and who are the biggest losers out of any kind of prolonged price war at OPEC? And does it change now potentially the inflationary and the central bank outlook?
Well, it does. I mean, one of the reasons why we entitled our piece Better But Bumpy is that there are still quite a number of macro uncertainties that will almost certainly mean that the path of performance for equity markets will be anything but straight. And we do envision some air pockets. One of those, of course, the larger issue is inflation pressures. And we've looked at this in some detail and examined the spread between input costs, which are proxied by the producer price index, and output costs, which would be the consumer price index. And that widening spread between the two suggests there might be some margin pressure. Now, of course, if oil continues to have this increase, and we have been expecting, by the way, increases in oil prices, but this is obviously a new supply side shock, if you would, that sort of intensifies those underlying inflation concerns and the wider spread between input costs and pricing power. If you follow that logic through, it suggests that the beneficiaries would be the ones that are more in the upstream part of the economy, whereas the ones that would be more at risk would be the downstream ones, to the extent that they cannot pass through all the cost increases that they're facing.
Right.
So, in fact, one of the strategies that we have is an upstream versus downstream one to take advantage of that margin differential.
What's the strategy that you have in China? Because this GTV chart on the Bloomberg showing the pressure on the CSI 300 breaching that very crucial 200-day moving average technical level. But at the same time, of course, we have these regulatory concerns that continue to add to the pile of concerns over what's happening across that country.
Very true. I mean, we've taken what's perhaps maybe seems somewhat of an heroic stance. I mean, we are overweight China and think that a lot of the bad news which has been accumulating has been pretty well discounted in the market. Now, it would be incorrect to say that, all the potential news or uncertainties have been priced in, because just axiomatically, you can't say that. But if you look at the sort of earnings growth that we're looking for, which is 23% this year and 15% next, the fact that China, having started the year very, very strongly, up 21% in the first 6 weeks of the year, then retraced all of that and has basically closed the first half flat. That means that the underlying earnings have been accruing while the markets basically has trod water, which means the valuations have compressed. So we think that from a risk versus reward standpoint, a lot of the concerns that the market is understandably focused on have been well reflected in prices. Now, the recent news flow, particularly with regard to regulatory intensification, is clearly the nearest and most significant pressure that the market faces. Our broader view is that we don't think that the regulatory authorities are trying to completely eradicate the profitability of the private sector companies. We think that what's going on is really more of an attempt to level the competitive playing field, to close areas of regulatory arbitrage. And the most recent front in this is, of course, data security. We think the market overall can digest that. The companies are adapting. And so we think on a longer term view, the risk reward setup here, given how much has been priced in, lends us to take a more constructive view on the market overall.
Tim, when it comes to growth prospects across Asia, of course, we know that China has been the first to rebound. We saw the recovery. How do you play that into your strategy of which are the next markets to outperform?
Well, it's a great question. And there's going to be, I guess, what you could call kind of this rolling series of recoveries. So the further south you go, generally, the worse the COVID outbreaks have been. I mean, India is a great case in point, which had a very significant surge to over 400,000 cases a day, and that's come down very, very nicely. And we're expecting quite a meaningful rebound to happen fairly soon. Indonesia is the country where you've got the most pressing immediate issue in terms of average daily cases. They're surging over 20,000 a day. In that case, there's been some fresh lockdowns, as I'm sure everyone is aware. So what we're going to see is basically this kind of rolling recovery where the peak of that recovery will be spread out over time, with the Southern Asian economies being the ones that will probably hit that peak later. So one of the concerns that investors have had is the issue of so-called peak momentum in terms of growth and earnings. That's generally sooner in North Asia and will be more delayed in South Asia. So probably as we go through the second half, you'll see some of the incremental momentum start to shift down from the north to the south.
Tim, I want to throw up this chart and get your views on this whole Didi Chinese government drama. This chart showing the Hang Seng Tech Index drawdown is now nearing 30% from the peak. What do you make of this? The timing of the regulatory action just days after the US IPO. Is it just a reminder of the not so invisible hand of the state here?
I mean, there's a lot of different interpretations on that, and the news flow is still coming in. And so I wouldn't want to opine on, motivation and whether the timing is coincidental or not. I think what we can say is that there are clear efforts on the part of the state administration for SAMR, for monopoly regulation, where the focus is on ensuring a level competitive playing field to reduce some of the inherent perhaps market abuses that are inherent in the economics of many internet industries, where there's a terrific benefit to scale, and the largest players in a particular industry tend to have outsized market influence. So I think it's an attempt to both protect the consumer, to ensure that the competitive playing field is more level, and that one is sort of playing by fair rules. I guess the key point that we'd emphasize is we think that a lot of the concerns about those updating and refreshing of regulations have been pretty well discounted in share prices, as evidenced by the chart that you just showed. And so from a risk versus reward standpoint, one always has to take into consideration how much the market has already discounted. And I guess our view is that a lot has been discounted, and therefore we think the risk reward is to the upside on a kind of a 6-month view.